Thanks, everyone, for joining us on episode 28 of Bullish. Remember, anything we discuss is not individual stock advice. Past performance is not a guarantee of future results. Stenger Family Office and his clients may hold positions in some of the stocks discussed. For a full disclosure, visit StengerFamilyOffice.com. I'm Sam Hardy. We've got Nick Stenger here, producer O, and our resident Greek, KP, with us in the studio today. We are Stenger Family Office for the past 44 years. Yes, 44 years. It's been our mission to deliver clarity and confidence to help secure your financial future. Before we get started here, I want to give a quick reminder. We're 2/3 full on Investor Day. It's filling up quick, so if you haven't RSVP'd already, go ahead and do that. Reach out to Katie Poulos. We would love to see you there. We're going to be at Gibson Steakhouse on October 16th and 17th. We have some fantastic guest speakers lined up, so would love to see you there. We've also got Nick's live podcast, episode 200 of the Nick Stenger Show. When's that at, buddy?
August 26th.
There we go. So make sure you join us there as well. That's going to be downtown Naperville at Francesca's. Beautiful. What a spot. So we got a great show planned here. We're going to talk tariffs, the Fed, some earnings. We're going to talk specific companies. If you're not already subscribed, folks, please go ahead, do that. Give us a like, share the show, get that clarity, the confidence, the good news out there. Nicholas, how are we doing this morning, buddy?
We're feeling good. Another episode of Bullish. Can't believe we're back in the saddle here. And we do have a special episode of Bullish featuring a Thomson Reuters economist, which is going to be kind of cool.
That's going to be fantastic.
And years flying by. Can't believe we're in August already and having a blast. We got baby Hank now is actually 7 months and 2 days. So
there
flying
we go.
By.
Getting big. He's going to start breaking stuff all around the house pretty soon if you're not careful.
Not getting any sleep, but that's all good.
Yeah, that's all right. So I figured we'd start. We got the one big beautiful bill. We haven't necessarily talked about it on the show. Chris did a fantastic short little 3-minute video on this. I'm sure we'll get an update soon from him. But what do you think? We finally got that passed. It was a little iffy, through the 4th of July week there. I would love to hear your thoughts on that, buddy.
As they would sometimes say, it was kind of a nothing burger. Nothing too exciting. Didn't really move the markets that much. Basically a continuation of the Tax Cuts and Jobs Act from 2017. I think the Democrats would have been forced to do this regardless because it's super unpopular to pivot and raise people's taxes, and they definitely were going to mess with the headline rates. So basically Trump got the extension approved. He's also, I think the most important thing is he got the $30 million lifetime estate exemption through as well if you're a married couple. And people don't understand how important that is. We were talking about how there's so few countries on earth where you can actually pass money down without these massive taxes. The UK, for example, got like 700,000 pounds and everything's at a 50-60% tax rate, which is crazy. So, I think the first time around in 2017, what happened was that tax bill made the U.S. a safe haven for entrepreneurs, and that's why we've seen such a boom. We've seen the U.S. just absolutely take off compared to other developed markets. You've seen the U.S. compared to Europe, compared to Japan, compared to China. Not even close, night and day, especially when you consider GDP and you consider earnings growth and where the innovation is. All the biggest and best people are here, and that's because of the tax bill, I think, from 2017.
Well, and you did a fantastic job on, I think it was your last episode, just talking about it's clearly not working out well for the EU or the UK. I mean, the UK has had a record number of millionaires leaving, which, you raise taxes, and they're talking about raising taxes again. And it's like, well, have you guys not learned your lesson? The more you raise taxes, the more people are going to try and get out of there so that they can keep more money or pass more money along to their dependents. So, yeah, obviously not working out there super well, but a fantastic bill that we got passed over here. I want to talk tariffs, too, since we're talking about Trump and some of these things. I mean, these are basically just negotiating tactics at this point, right?
Yeah, anyone who's still selling the news on tariffs didn't learn their lesson the first time. How many times did we say this? We said, hey, you're going to see volatility. You're going to see a correction. Didn't know how quick it would be. It was pretty fast in April. April 7th was the bottom of the market. S&P traded sub 5,000 points. That was a pretty big hit. I mean, we ran up to 62, almost 6,300. We dropped like 20% in a couple of weeks, and I have never gotten more calls from clients saying, "What's going on? Should we go to cash? Should we panic?" Like, no, you got to do the exact opposite. And then all of the doom and gloom strategists came out, not to name too many names, but literally every big bank on Wall Street cut their estimates. And they should be embarrassed of themselves. They should say sorry. I've been calling for them to say sorry. So far, nobody's done it yet. And they're all just...
I don't think you're going to get that apology.
Still waiting. You might be right. But, they should say sorry because they cost people a ton of money. And then, they reversed it and they said, oh, well, now tariffs weren't as bad as we thought. So we're going to raise our estimates again. Oh, really? So that's how you guys do it? You cost people a bunch of money, you cut your estimates and you raise them. And then you go on CNBC and pretend like nothing ever happened. Like, what are we doing here, guys? So Stenger Family Office, we said, hey, stay on your plan. Don't worry. This too shall pass. It's not the end of the world. Certainly not as bad as COVID when we said to do the same thing. I mean, COVID, we shut the world down, and the market was down 35% in 2 or 3 weeks. I think a lot of people forgot about that. And I just say, hey, there's no way tariffs are going to be as bad as COVID was. And we still said to buy stocks during COVID. And remember, during COVID, people were saying it was going to be a new normal. The world's never going back. It's like, I've traveled a lot this year. Planes are full. You can't get on a plane. Hotels are full. We're back to normal. So anybody, just a lesson for all of us, anytime somebody says things are never going to be the same, the world's coming to an end, just go back to the book of Ecclesiastes. Nothing new under the sun. Everything that has been done will be done again. There's nothing new. And you shouldn't be surprised by anything, right? And so that's why I think the fundamental reality of the way we run the portfolio was just stay the course, stay on your plan. There's going to be some companies that get hurt more than others, but if you got 50 companies, most of them are going to be okay, and that's exactly where we're at today.
Yeah, and we've definitely seen too. It just out of the blue, we'll get a headline, hey, tariffs have increased here, and then it's like 24 hours later, oh, a deal was made, and so I would agree with that, and I think we started booking out for Investor Day 2027 already, which is going to be next fall, and even now it's like, well, we got to start picking our dates because those weeks are filling up. So it's like, well, you're telling me the consumer is doing bad, things are not going well, the economy's tanking, and we still can't. We still got to book over a year out for an event to make sure that we can get the space that we want. So, it's just crazy. People are still spending money, as we've seen.
Yeah, I think it's important to note, though, there's a difference between this Ferrari economy and then everybody else. And I think that's what's happened the past 5 years is as the money printing has gone up, people with assets have been fine. I've been saying this on the show every week. The sad reality is people without assets have gotten absolutely destroyed, right? Because if you make $100,000 versus $1 million or $5 million or $10 million, like a top 1%er would have, it's just a little bit different because everybody's got to buy basically the same amount of groceries. Everybody's only going to drive one car most of the time, right? You can only drive one at a time, right? And so then the math of how much your expenses have gone up in relation to your income has not been the same for the top and the bottom. So the reality is for the top, you get all this net interest, you get all this money from your cash in the bank. Look at the biggest companies; they're the same way. Microsoft, Apple, Berkshire Hathaway, making more money on net interest on their cash in their on their balance sheet than a lot of companies do in revenue. That's an amazing factor. That's never happened in U.S. history before. And so it's changed the game of the best and everybody else and the best companies, right? And it's also unfortunately changed the game between the top 1% and the bottom 1% to one of the biggest gaps we've ever seen. And I think that's really sad. I think that's not how we should have things. And that's because of the Fed. So anybody who says that the big government's better and all this stuff, I had this great chart. I didn't have it for the show today, but it's a difference of North Korea versus South Korea, the GDP. And it's like not even close. It's like 10 or 12x difference between capitalism and communism. And I did a video on this for the weekly show, and Katie put a clip up, and like 10 or 12 people gave it a downvote, and some people wrote some nasty comments like what? So communism's good? Is that what you're telling me? Because, you could argue all you want. My grandma came out of communism. She came out of socialism during World War II. She escaped the Nazis in Europe, and she came to the U.S. when she was in her 20s. And, she never looked back, okay? And she said, the U.S. is the last and best place. And yeah, we've got our issues, we've got our problems, but the bigger and bigger the size the government gets, you're going to crush the middle class. You're going to crush the low class. And that's exactly what happens every time. She even told me the stories how she remembers of kids playing with stacks of money in the streets, okay, because it was worthless.
Yeah,
it was worthless. Millions and millions of dollars just playing within the streets because it didn't mean anything. And so we've got to figure the inflation thing out. And but for the top 1%, it's good enough to power the rest of the economy, and that's why things are doing well. That's why we stayed bullish. That's why we said the economy is going to do okay. We said to everybody else, we said, hey, buy assets. Make sure you're in assets. Make sure you're in stocks. And yeah, your cost of goods is going to be up 40-50%, but at the same time, your assets should be up 40-50, maybe even 70-80% in some cases as well.
Do you think we're going to see inflation as a result of tariffs?
No.
Or you think it's, kind of like what we've talked about, the Milton Friedman, M2 money supply. If we see an increase there,
No.
that's what's going to drive inflation?
Yeah, I think inflation, I think tariffs actually, now I don't think the tariffs are really going to stick the way people think, but naturally, I think what's going to happen is people are just going to pull back, okay? And so the reality of these tariffs is probably you end up in a recession. And I've been tracking this for a while now, and I've said this, I've supported some of the things the administration's done. I said, hey, tariffs, I get it. I understand what you're doing. I think the better way to do it is not tariffs. It's probably just to delist Chinese companies on our stock market. Yeah, that's probably the turn off the lights like that, right? If you really want to deal with China. And that's what he's proven that he wants to do. Yeah, he's gone hard after Latin America and after Europe, but the biggest one is China. They're the public enemy number one of the trade war. So,
and I think that's at least brought him to the table, because when this whole thing started going down, I don't think they could get Z on the phone, and vice versa. They weren't really in the mood to talk. But now Besant's been over, was in Sweden, I think he was over there, and they were having talks and sitting down. There's still not a deal there, but we also, I think, can talk about the fact too. Isn't there like an element of securing our border as well? That's part of those tariffs.
I think that's part of it.
The fentanyl tax.
Possibly, but I think the biggest thing underneath the surface is oil. That's what this always comes down to. And it also comes down to where do the Chinese get their oil, but also the Europeans, okay? And Trump rightfully said a couple years ago, I'm not saying I love everything he does. I'm not saying everything he does I endorse, but one of the things he did do is he sat in front of a room of EU leaders. He said, you guys are toast if Putin ever does anything, because all of your energy comes from Putin.
Well, and India has been in hot water at the start of the week here because they were getting their oil from Russia.
Exactly. So it's like, how are you going to get these sanctions on Russia approved if he just has to, turn off the heat in your conference room and you're done? So I think that's the same thing with China. China is totally reliant, and this is why they're pushing the rare earth minerals so highly, because they want to get themselves off of U.S. oil and gas. And that's the biggest resource we have here in the U.S. We have all this fracking right on our feet. We have all this energy. We have more energy than anywhere on Earth. And by the way, it wasn't the Trump EPA that approved them. It was the Obama EPA that approved them and said you could frack. Okay, and so we've got all this energy. And so I think what this really comes down to is he's going to twist Z's arm a little bit, get him to buy U.S. energy, and that could be a huge game changer. That's why I've said the U.S. has already won this trade war. It's already over. There's no question. And I think China needs us a lot more than we need them, and that's pretty apparent.
China, I know I've seen some reports as well, and I saw a chart the other day, but people have basically compared the real estate crisis that they're going through right now to our '08 and '09. It's not like they have a healthy economy, and they had continued to print and spend coming out of COVID as well, far after we were doing it.
Oh, for sure. I mean, China is the number one printer of money, right? Every communist country on earth. That's why every communist country ends up in massive inflation, because they have no productivity. Okay, because anybody productive, anybody who's innovated or an entrepreneur, they just throw you in jail. Like Elon Musk. Imagine Elon Musk in China. Like, how long would he be able to tweet?
Not that long.
Not too long.
And he wouldn't be able to own the company because it'd be owned by the CCP.
Yeah, whether you like him or not, you should like his freedom of speech and his right to speak, and you should support that. And also same thing with Jack Ma. Look at Jack Ma at Alibaba, goes missing for months. That's like basically the Jeff Bezos of the United States.
Yeah.
And he disappears. And you go, what in the world is going on? And so that's the problem. They chase all their entrepreneurs out. Europe is basically like a mini version of this, right? And you could say there's elements of it in the U.S. I'm not saying there's not any elements in the U.S., but Europe is going down that road too. And, I think, anytime you chase your entrepreneurs out, you basically chase out your wealth creation, and then you got to print money. And printing money is like a Ponzi scheme, right? It's only as good as you can like make people believe your currency is worth. And then after you run out of people who believe that, you're done. And that's what happened to Argentina.
Yeah, which has been on the up and up here. But let's go. We were going to talk rates at the end, but you brought up Powell and some of these things that we were looking at. Obviously, last week, Wednesday, was the open market committee meeting, for July. We did not see a cut. Maybe if he had some of the jobs data information a couple days earlier, we may have gotten a different result there. But where do you think we're at? is there a stubbornness between this Trump and Powell feud? It was like I sat and I watched the whole interview with him, and half the questions were not even about the policy. It was all politically based. Hey, we saw Trump came and visited and looked into your project. How was that? And I thought Powell did a pretty good job at not trying to get too political on it, but it definitely seems like there are some undertones there where it's not just policy and looking at the data.
Here's what I think. Okay, I don't think Powell is anti-Trump at all. I really don't. Maybe he's just annoyed of him and stuff like that.
Trump appointed him in the first place.
Yeah, that's the other thing, right? So I really genuinely don't think Powell is politically motivated or anything like that. But more importantly, and probably worse, is I think he just doesn't know what he's doing because no Fed chair has ever known what they're doing. It's like this massive job to control all the money in the country. You're not supposed to do that. You're not supposed to have central control of the economy. And he does. And so because of that, I don't think he's working with the right data, just like they weren't working with the right data during 2020. So, you could say, oh, Nick, you're just bashing Powell and all this stuff. No, I'm not bashing Powell, but he was wrong in the first place. He was wrong in 2020. He should have raised rates in 21 at least. Didn't do it until 2022. That's why we're in this mess in the first place. So you could say whatever you want. Trump, Powell, doesn't matter. He was wrong the first time, he's wrong this time, because that's just every Fed chair. They're always going to be wrong. You can't centrally plan the economy. So all that being said, I think he's 0.5% over where he should be. I don't agree with Kevin Hassett. Kevin Hassett's saying he's 1.5 points over. That's not true. But I think he's about 0.5 point over, and I think he will deliver those cuts, but I'm concerned that he delivers them too late. I mean, I'm telling you, the job market's getting tougher and tougher and tougher. And we just put a posting out for a client service person, and we got 114 applicants in 3 days. Okay, that didn't happen.
Insane.
Yeah, it didn't happen 2 years ago. I'm telling you. So things have changed in the job market, and if he's not careful, he is going to trigger mass layoffs. And Microsoft already did a huge round, 12,000. You're going to see more and more of this. Companies are just going to say, hey, we're on pause right now. Now, some companies are going to blame it on tariffs. They're going to say, we're on pause because we don't know what to expect. But Microsoft does not have to deal with tariffs the same way most of these companies do.
No.
So Microsoft doesn't lay 12,000 people off because of tariffs. They lay people off because I think they say, hey, the cost of projects has gone up. The hurdle rate for a project now is 7-8%. And if you can't get 7-8% IRR, you're not going to do it. You're not going to take risk. Right? I could sit on my $100 billion in the bank, if you're Apple or Microsoft or any number of these companies, and I can make 4% with zero risk. That's the problem. So until you get interest rates down and you make the cost of capital a little bit more accessible, you're not going to have these this massive turnaround. So I think you could, to go back to the recession thing, I think we could post a small recession, and they're going to be all over it. Unlike in 2022 when the media didn't talk about it, we did have a recession in 2022. I think this time around we could see a little technical recession, and the media is going to panic. But what we also know is right at the time where the recession is actually called by the government authorities, that's when the market's back to record all-time highs.
Yeah, because you're looking at least 2 or 3 quarters following, like once we actually get the data that shows that.
Right.
What do you, talking about data, what do you think of the reliability of some of this data? We're talking for May and June non-farm payrolls, you basically had those revised down 270,000 jobs. That's not a small number. It's a very, very different number, because overall it was like we started at like 310,000 or whatever, and you just knocked 270,000 off. That's not a small mistake. Is the data flawed, or do you think there was any foul play there? I don't have an opinion either way. I know what's kind of been said, so I just figured I'd give you a chance to address some of it.
No, I don't think there's foul play. I think it's more so, if anything, it's just people that are incompetent. That's possible.
Yeah.
But more importantly, this has gone on for a long time, and basically they work in the lag anyways, because it's all these surveys, and then eventually they come back, they revise their surveys, and they say this is what actually happened. That's why we've stopped tracking that stuff, and we track a lot of real-time data. I could pull a report on LinkedIn in 2 seconds of all the open, unfilled jobs on LinkedIn. And I think that's a way better metric because that's real time. That's a company HR person posting a job or not posting a job, right? That's way better than the BLS data. Same thing like during COVID when we were following Brian Weisberry at First Trust, and they were publishing these real-time COVID trackers, and they were following TSA checkpoint data. What a powerful metric during that time. So, I think the same thing applies. So if you're still relying on all government data, you're probably behind the 8 ball. We try to be forward-looking. We try to tell you tomorrow's news today and not tell you what happened last quarter. And that's a big difference.
Yeah. All right. Let's hit earnings here, and we'll finish with some specific companies in regards to that. But so far, tariffs were expected to really have a large impact on earnings, and we just haven't seen that for the second quarter. We've got, as of July 1st, FactSet does a great job at getting this info out. We've got 66% of companies that have reported, 82% have beat their earnings per share estimates, 79% have reported revenue beats over what analyst expectations do. This is the highest since 2021, basically part of that COVID recovery once we had some supply chains regulating and everything like that there. So it's expected that we're going to see this growth continue in Q3 and in Q4. What do you think can hinder some of that, or do you think we're smooth sailing towards the end of the year?
So any company that took on excessive debt during COVID is paying the price today. Any company that did not take on excessive debt, maybe they didn't grow their revenues a bunch, but they didn't take on a lot of debt, they're okay. And any company who managed conservatively through these different crises is sitting okay right now. And so you're going to see their earnings do well. They've got a cash reserve and all that stuff. So I think I think most of these companies in the top tier of Wall Street are going to be just fine. You look at Home Depot, they're going to make it. JP Morgan's going to be okay. They got a fortress balance sheet like they always talk about. Microsoft's going to make it. Apple. Not every company's going to make it. We were going to talk about Traeger, I think, a little bit later. And Traeger now, this is the company that makes the smokers and grills. The last quarter in March when they reported, they were doing $143 million in revenue, which is not radically different from where they were during COVID. Remember, COVID was the boom time for smoking meats. You had nothing to do. Get a brisket, throw it on for 18 hours. That's all you have time for. Okay, $153 million in 2020, $143 million today. That's not radically that different. But what has changed is their interest expense because they're on variable rates. And so their interest expense during 2021, for example, was $7.8 million for the quarter. Today, that interest expense is, actually it's still $8 million. But the big difference is they're not able to pay down their debt the same way because they're now sitting on $550 million of debt on their balance sheet to make grills. And I've made the point on this show before, on my show, what do you need $550 million of debt to make grills for?
So do you think this is why small and mid caps have struggled relative to large caps as well? Because during that COVID period, they did have to take on more debt to survive during that time period? That's
a huge factor, for sure. For sure. Yeah. Or they just didn't manage their balance sheet correctly because, we're a small company. We got zero debt. Okay. Not every company can say that. We've made a conscious effort to do that. We've tried to grow sustainably and we don't have any debt. And so, we could have a downturn. Market could go down. Our revenue goes down. Our we have to be careful, right? Just like any company. But at the same time, being debt free, it reduces your IRRs, but it also improves your survivability, because leverage makes everything look good during a good time, and during a bad time you could get wiped out. So I think you're right, but I think it's also just bad management. I think a lot of places believed, hey, we're going to have 1.5%, 2.5% interest rates forever, and then those interest rates changed and went up. By the way, they took what Powell said verbatim. Powell said rates are going to be low forever. They believed him. So that's not necessarily 100% their fault, but if you could be debt free, that's what we tell our clients in retirement. Try and get debt free, because just like a company, it's way better to not have debt when you go into a declining period of time.
All right, let's talk good results here. Schwab, we've just talked about how fantastic they've been. The stock's up 40%. It's been a key, leader in the financial sector. What do you think there? Do you see that as a trend that's going to continue?
Schwab is one of the best stories to me, other than Casey's General Stores. We've covered Casey's before, absolute ripper of a stock, but
Okay Pizza.
Okay Pizza, yeah, we gave it like a 3.2, 3.4,
something like that.
Yeah, it's not great.
We ate it before a flight. Wasn't our best decision.
Yeah, definitely not before a flight. Wouldn't recommend it. But otherwise, Schwab is a great case study in just pure understanding of the business fundamentals. What drives actual customer interactions, right? And if you understand these companies fundamentally of why customers go to them in the first place, you could find a stock like Schwab early on and make a ton of money, because they came in during the 70s. Charles Schwab came in during the 70s, and during a time where they had minimum mandatory commissions, you had to charge $300-$400 for a commission, right? Standard. He said, okay, well, we would like to do the opposite of that and not charge as much. And then regulation changed where you were able to do that. Okay, it was regulated. You had to charge a standard commission. They changed that, and they said we're gonna, instead of being anti-customer and all this stuff, we're gonna be pro-customer. We're gonna do the right thing for people. And turns out that's an attractive business model. And all these people started coming in, and so their business model is not based on fees. They do have fees and things like that in money markets, but most of their business model is built on net interest. Essentially, Schwab's just this massive bank. And as they attract more and more assets, they make more and more net interest. They're also highly profitable. Their margins are like 40, 50%. They're basically printing money. And the more and more they do the right thing for customers, the more customers come to them. It's just this amazing formula. I know it's not rocket science.
And we've seen some really strategic acquisitions from them as well. And personally, we use Schwab, so we've seen the impacts of that. The technology continues to get better month after month. They continue to try and bring forward a fantastic product for both investors, individual investors, and advisory businesses like ours.
Yeah, and again, on a fundamental level, you compare them to Bank of America, Merrill Lynch, not to knock those guys. They used to be the number one place on the street, right? It was the thundering herd. Merrill was the best place to be. Morgan was great, right? All these different places, but, they just failed to innovate. They stopped, bringing out new technology and making it a great place for investors. And so now you've seen Schwab the past 40 years now, 45 years, their stock has gone up 33,000%, if you can believe that, 33,000. So this is real, and again, when you're looking to invest, you're going to be wrong once in a while. You're going to buy a stock for too much once in a while. You're going to go down in the short term. But if you find companies that have these business models that attract customers and can retain customers, the stock goes up. It's not radically hard to figure it out. And I think the same again is true of Casey's. We talked about Robinhood. Robinhood now is 26.5 million customers. Is that correct?
Yeah, users.
Their average account has tripled, I think, or doubled the past year, and now they're overseeing $280 billion in assets.
And that's doubled, I believe, in the last year. I think it was a 99% increase year over year. And part of that is assets have performed well. I know they've kind of had a crypto partnership that's come out, and those assets have done very well also. But it is a little crazy on a year-over-year basis. They've doubled their assets under management basically.
Yeah, absolutely. So we're trying to, at Stenger Family Office, this is what we look for, is companies like this, not investment advice, but just companies like this that attract customers, can keep them, do a good job for them. It's not rocket science, and then try to pay the right price. Sometimes we're right, sometimes we're wrong, but I think out of a portfolio of 50 or 60 companies, you find a really good basket of companies, and you're going to do fine over the long run.
All right, and let's close here. Let's just talk really quick. Speaking of good companies, we had 4 of the Mag 7 names report last week. You had Meta, Microsoft, Apple, Amazon, all reporting, all strong, all beat guidance all beat analyst expectations on top and bottom line revenue. However, we did see some mixed results as far as performance was concerned. But, you have to own some of these names like this. When we talk about creative destruction and people who are innovating, these companies are at the front lines of that. Some people might argue, well, Apple hasn't come out with some new really innovative product in a little while. I mean, you're still going to buy the newest iPhone.
Yeah, for sure. I mean, you look at these basically monopolies. They're legalized monopolies. Microsoft, yep. Apple, Amazon, Netflix to a degree, right? But less so. And you have to own them. Because even if they break them up, Google especially, right? You have to own them because even if they break them up, the parts are still extremely valuable. And so, there's just
YouTube's worth like $400 billion or something like that. If you broke that out of Google,
that's exactly right. And so I think the tough thing for investors is just to say what's the right price, because if you pay 100 times earnings for Microsoft, that's probably a little rich. But, if Microsoft trades here at 30 or 35, you say, well, it's a little bit higher than 10 years ago, maybe a little bit higher than 15 years ago. But Microsoft is much more dominant today than they were 10 or 15 years ago. and the revenues are there, and the products there, and the cash flows are there, and the balance sheet's there. So it's not the old school days of the 1990s where the world was coming to an end, and you were buying pets.com for 500 times earnings or something. So it's just a different environment. These are real companies, real businesses. Not to say they're not going to have a correction. Microsoft went from 4 something down to
it was like 380 at the low,
360
at the low,
365,
and it's
or
up
something like
50% now in a matter of 4 months, 3 months.
Yeah, and I had somebody text me about that saying, "Oh, I can't believe you had me in Nvidia and it goes down 50%." Well, Nvidia from the low now is back up to a brand new record all-time high at 180, and it's just hard to time these things. If you're diversified, if you own them on a plan, you'll be okay.
Yeah, I would agree with that. And we've got, NVIDIA will report earnings at the end of the month here. We may get just a little snippet with AMD later or I believe today's the 5th. AMD's reporting after the bell, if I'm remembering correctly. So we may see how some of that AI sentiment continues there. But overall, August is generally a weak month, so we may have to give a little bit back. It's just kind of part of the game.
Yeah, I think so. I think you probably have a little bit of a pullback here in August, like we're seeing, maybe 4 or 5%, and that's your buying signal, right? And so I think anybody who's been waiting for time to get in, don't wait. Get your money to work. But if you're dollar cost averaging, I think August is going to be a great time. And if you see where the earnings estimates, like you talked about, are coming in, we're looking at $340 in earnings. Okay, multiply that by 20. Not hard to get to about 7,000 eventually, 6,700 to 7,000, and you're going to continue to see earnings growth for the next couple of years, and so that will push, in my opinion, the S&P past 7,000 points. And if you're doing this on a plan, you don't care when it happens. You're just going to ride it up to 7,000. You're going to collect your dividends along the way, and just be on a goals-based plan.
Yeah, you got your safe money for a rainy day. But no, fantastic thoughts. Thanks, everybody, for listening. That is episode 28 in the books. Remember, RSVP for Investor Day, October 16th and 17th at Gibson's in Oak Brook up here. Texas folks, people from the South who are our clients, we would love to have you join us. We promise, well, I'm not going to make this promise, but the weather should be just fine. And again, to come check out the Nick Stenger Show live episode celebrating 200 episodes, basically 5 years doing it. Unbelievable. So that's going to be August 26th. So appreciate you listening. We'll see you next week.